Hello, I'm Carolyn Herbert from the Finance News Network, and joining me from integrated financial services provider Five Financial to talk about instalment warrants and how they can build wealth is Head of Wealth Management, Jason Petersen. Jason, welcome.
Thank you, Carolyn. Pleasure to be here.
Now, can you start by telling us a bit about your business?
Certainly. We're an integrated financial services business offering holistic advice across a range of structures, strategies and products through superannuation and non-superannuation, along with taxation advice, and all about giving clients clarity and certainty in their financial future.
And in what situation would you suggest to your clients to consider instalment warrants as part of their portfolio?
So we've got the young accumulators that are starting out, don't have a lot of asset, but want to get exposure to growth assets, and instalment warrants are a great effective way of doing that. Secondly, we've got clients with substantial assets all tied up in growth assets, and what we want to do is diversify away from the growth assets, give them a bit more protection. We can use the instalment warrants to do that and get the same level of exposure to the growth assets, meanwhile having a fair chunk of their assets sitting in defensive assets as well. And then we've got the superannuation accumulators, where we can use instalment warrants to create additional franking credits and dividends to create a longer term income stream for them.
And how do you go about explaining instalment warrants to your clients?
Pretty simple. It's actually borrowing to invest in shares using a level of protection or insurance against your loan as well.
Instalment warrants are often compared to margin loans. Do you think this is a fair comparison?
In some ways, yes, because you're effectively borrowing to invest, which is a margin loan. Secondly, you've got the exposure to both the growth in the underlying assets and the dividends and franking credits. On the other hand, no. There's no credit checks for instalment warrants. There's also no margin calls, which is really important, a key issue with margin loans. And more importantly, instalment warrants are non-recourse, so they can be used in self-managed super funds.
So Jason, why is the non-recourse feature so important then?
Carolyn, there's been a lot of talk about borrowing within superannuation, and the legislators quite rightfully are concerned about people taking on too much risk by borrowing too much money inside of superannuation, obviously exposing their assets to the risk of a major correction. With limited recourse borrowing, the only recourse the lender has to the borrower is to the asset they actually borrow against. So it provides a greater level of protection for the superannuation investor.
And are a lot of people surprised you can use warrants in self-managed super funds?
No, not at all. It's because it's providing limited recourse. The fund and the fund mandate accommodates that, i.e. your investment strategy. There's not a problem with doing that. A large part of the warrant investing in our practice is actually through superannuation and is used in a reasonably conservative manner.
So what is it about instalments that make them so attractive?
Firstly, you get the ability to gain exposure to growth assets ideally through conservative borrowing. We get an increased level of franking credits and dividends, and that's very, very tax effective outcome for the funds. You can have protection, so you can insure the loan essentially, so you don't have to, as we mentioned earlier, with that limited recourse borrowing. In our practice of particular importance, we create long-term income strategies for clients through a higher level of dividends and a higher level of franking credits.
So how long do your clients typically hold them for?
Yeah, we hold them until the expiry of the warrant, and we particularly use self-funding instalment warrants in our practice, where the dividends go to pay off the loan over time.
And have you got any examples of that?
Probably a really good example off the back of the GFC was Commonwealth Bank self-funding instalments. So essentially, Commonwealth Bank was trading at the end of the GFC at about $30 a share. So, say for example, a client wanted to buy 10,000 Commonwealth Bank shares worth $300,000. They only had to contribute $150,000. Now, over the next 5 years, the dividends of Commonwealth Bank paid off that $150,000 loan. If we look today, that client with those 10,000 Commonwealth Bank shares is getting a dividend stream of $60,000 a year, including franking credits. And that's a really good example where there's no loan still sitting against the Commonwealth Bank shares.
Now, on the other side of the coin, though, what should investors be watching out for?
A number of things. In the first instance, instalments are essentially, you've got to have a positive view on what you're actually investing in, the underlying investment. That becomes the number one priority. Secondly is liquidity, making sure that whatever you're buying as an instalment, you're looking at the underlying stock again and making sure that's liquid so you can actually get in and out of it. The level of dividends is really important to ensure that, particularly using self-funding instalments, that over time the loan is actually going to get paid down. The interest rate is important as well, and all the other costs associated with the instalment, because there are costs in there. And obviously the interest rate risk, that if interest rates go up over time, it's going to be a lot harder to pay that loan down, so you end up with a bigger loan than what you started with.
So what about trading? Is buying instalments like buying shares?
It is actually, and essentially you're buying them through the exchange like you do underlying shares. And the key litmus test here is really making sure that you've got liquidity in the underlying stock. If you've got liquidity in the underlying stock, you're going to have liquidity in the actual warrants. So it's quite simple and all registered through CHESS as well.
And Jason, do you have any final thoughts for those who are thinking about giving instalment warrants a go?
Certainly, in the first instance, do your homework and make sure it really suits your goals and objectives. Be mindful of the level of gearing, because there's a broad range of gearing you can have, and be aware of the risk. As with any investment, look at diversification. So don't just buy one particular stock. Obviously, read the product disclosure statement. There's a lot of information in there that tells you a lot more about what's really going on behind the scenes. When they're used appropriately, they're a fantastic tool. Don't be afraid to give it a go, and if you need to, seek advice for it.
Jason Petersen, thanks for your insights into instalment warrants.
Thanks very much, Carolyn. Appreciate it.